Hello everyone, welcome to Algorithmic Trading London, and thank you for joining us. As you all probably saw, we've got a number of talks. So Richard here from ProfitView is going to give you a demonstration of their software and how you can build algo trading in Python. And we've got a talk from Dr. Kum on triangular arbitrage. Sorry, he's over there, so I was looking for you and not seeing him. So just to give a little bit of history about this group. This group started out a series of webinars that we did about 2 years ago that are on ProfitView's website. So for people who are interested, we had people like David Grimm, we had what's the crypto trading company, Portofino come in and give a talk about how to get into high frequency trading as an industry. We had a whole load of talks from different people in the industry, and from that we decided to meet in person about a month ago, and we had a meeting in King's Cross, and everyone was really keen. People made lots of friends, and people were keen on doing it again. And so this is a members group. The talk that you're going to be getting from he came along and volunteered to talk. So please be kind. But also, it's a members group, so we'd love to get people talking about what they're doing, and if they're doing projects at home, what their projects are, and really anyone can talk. That's the idea. From the webinars, we also started a Telegram group. We've got about 550 members, 600 members, something like that. So if people want to join, there's a forum for discussion about algo trading. There's some people in the industry there. There's often discussion about how you use certain techniques, what papers people are reading, which books are interesting. It's really just a place for discussion. So I'd encourage you all to sign up and join and be active participants. Okay, and just one more news item. There's been some discussion. One of the questions that comes up in the group a lot is people want to know about the industry, and they want to know what books they need to learn about the industry. And so this was a book that there was discussion about a month ago. It was due to come out on Amazon. It's been released in the last few weeks. And for those who don't know the author, there's somebody who's based in Chicago who's worked for a lot of the high frequency trading companies out there who's now wrote a book about it. So if you're interested in what goes into high performance C++ low latency systems, it's one of the best sources of reference out there right now. So that. And then, so I've actually stole this from another slide deck because I'm involved in organising C++ London, which is another meetup group. We often have financial talks there, but the premise is the same. If you want to do a talk, come talk to one of us. If you've got something, you're working on trading systems at home, you're something you're happy to talk about, techniques you're using or things you're interested in. It's for everyone to come and contribute to the group.
Don't be shy. Don't be shy at all.
Yeah.
Everyone see it.
Cool. And without further ado, I'll hand over to Richard, who is going to show you what ProfitView does.
So this, as Anthony was saying, this group is about algorithmic trading, and he's given you a bit of a history of algorithmic trading, and what I came to, and also Jahan came to algorithmic trading through, is our histories, but also our interests in algorithmic trading. And as another part of that has been the formation of this company, ProfitView. So you might say that these are sort of two directions we've come in, rather than being so much that we've come to this group from ProfitView. The two have come from the same origin. So first, I'd like to show of hands. So who here are programmers? That could. Okay, all right. Right. So to keep your hands raised if you're a programmer, including amateur or hobbyist programmers. Who here of you loves programming? So you don't have to. You could be a really good programmer at work, and then or for a particular purpose, and then you go home and you really don't have anything to do with it. Okay, so who amongst you is knowledgeable about finance and financial trading? Okay, and keep your hands raised if you're also a programmer. Okay, all right. Well, yeah, so it's a good number. We've got an interesting group here. So let me just tell you a bit about myself. So I'm from the traditional finance industry for many years. I've worked at these well-known places in these big teams where they have a lot of infrastructure, a lot of resources. And it's a funny thing, resources, what they mean, what does that mean? It means people. They have a lot of people. Why do they say resources? It's people, right? So a lot of people are put into teams. They paid a lot of money. These companies have a lot of money, and they put together financial trading systems using the best practices that have evolved to that time. And what that means when it comes to trading is that they use what we call event-driven systems. And that's what I've got to the point where I don't really conceive of anything else but an event-driven system to do financial trading. Whereas, in fact, if you were just coming into it naively, you might think in terms of systems like a sort of request-response thing. You're the programmer, so you ask for data. Depending on the data, you make a response. But in the industry, we use event-driven systems. I'll just leave that up there. So this is a different QR code, and that'll go to our link tree where you'll get to our GitHub and this sort of thing. So I'll leave that up there. So, sort of fundamental paradigm of trading in the industry is using event-driven systems. So I'm going to show you now an algo running in that using that mechanism. So this algo here is currently running. Actually, it's sure I might actually sorry, I've got the wrong one. This is the one which is actually running. Okay. The screen's going on and off, it sort of changes that. Okay, so this is a simple grid algorithm that I've been running for about 3 weeks to exercise the system. It enters orders on a periodic basis. These are live orders for the market. They do trade, and it has not done particularly well. As you see, it did quite well for a while, but I haven't really been looking after it. It's really just to sort of keep the system going, and but nevertheless, it sort of does some interesting things at various times. It's got some massive drawdowns, but basically, it's I keep it running. I like to keep it running. What I'm going to show is a sequence. Well, first, we talk about event-driven systems. How do we do it? So let me just show you what happens in ProfitView when you create a new algo. You click like this, gives you this untitled. You can then rename it, and it gives you entry points into the 4 main events that happen in the market. Those events are the trade update, quote update. These are public events, and then also a fill or order update. So orders you got in the market, when they change, you get an order update. And if it's a fill to one of your orders, then you can get a fill update. Now, I'll just show you that in operation. Let's see. So this one just prints out when there's a order, fill, or trade update, and it's right now listening to. These are the trading logs. Now I will start this algo. It's not trading. It's not a trading algo. It's just printing things out at the moment. Okay, so you can do that in ProfitView. You can do anything you like. It's called Python 3. So I start that, and look, there it is. It's running. If I now do a market order buy, right? What that will do is put an order in which crosses the market, therefore it will make a trade. It will also fill the order as it goes through, and also it's an order which will change. So if we buy it, okay, and this is what we've got. So we have a fill, an order update, and okay, that's the little thing that's the problem with the BitMax market right now. It doesn't tell me the trade, but the trade happened. You saw this thing pop up. We don't get that back at the moment. This is an issue with BitMax at the moment. Okay, so there you go. That's these are events which are happening due to in my code due to what's going on in the market. This is the fundamentals of event-driven systems. Now, you notice when I did that, I'll just reverse that. I'll put another one in, reversing it. Just wait until you see some reaction in the console there. 1, 2, 3. It's straight away, isn't it? Pretty good. Let's just have a look at what that latency is, in fact. So I've got this one. All this does is print whenever there's a topical update, a topical entry in the order, it'll determine the latency between that entry and the time right now when it gets to this function. So I'll just run that and see what we get. So these are the milliseconds it's taking. So it's around about 2 to 3 milliseconds. Sometimes it's a lot longer, or quite a bit longer, but it's that sort of amount. And that's because this is a WebSocket from the market itself. If there's an event in the market, it gets straight back to you, and you have this, you see it straight away. So it's pretty good latency. Now, I'll just give you an example of actual algo, and then we'll set it trading. But we won't trade this one in the market because that's sort of a little bit risky. So what we'll do instead is run this very simple mean reversion algo, paper trading. With paper trading, what we do is we get the live data from the market, but then we have our own internal order book, but we keep that data so that we can still see the P&L from that activity. So if I run that, just to say what this does, by the way, it goes and gets the last X prices from trades, and then takes their mean and their standard deviation, and then it'll enter a sell order if the next price, the current price you've got go above a multiple of that standard deviation, and a buy order if they go below. So it's sort of trying to get money from the movement of the market. It's a very naive strategy. It would really work. We're paper trading, so we don't mind too much. Okay. So let me just run this, and just to say that the execution is here. Create market order, and so it's a sell when it's above that level, and it's a buy when it's below. So let's get that running too. Let's see. It's going to collect some data, a little bit of data, but let's do trading. So we get yes, okay. So now it's making some trades. Yeah. Yeah. The text here.
Which will this be on
GitHub? Everything's on GitHub. Everything will be on GitHub. So it's done a few trades. So that's great. Now the thing is that in the system that you might build with ProfitView, you might want to expand out from just having a single file that's running your whole strategy, right? It's unlikely you're going to do it that way. You're going to have a much more complex one, and really you should let your mind wander and be creative, because this is full Python 3 and a lot of different ways to connect to ProfitView. It's really sort of the nexus of an event-driven system. But one thing we can do is, in fact, run multiple bots, and we can talk between them. So what I've done is changed this algo into one which is, instead of sending a market order, it just sends a signal when the time for buy. It just sends a signal to sell or to buy, right? Where does this send the signal? Well, we use Redis, and we have a built Redis server, and we send it with a pub/sub mechanism of Redis, and that gives us that allows us to send this data around. So I'll just start this, and just a second. Yeah, okay, so it's now, signal, time to buy, and it publishes the signal out. Now, then what we can do is, while that's running, is we create something to, it's even very, very simple, as you see. It just subscribes to the message that's being sent, and when it gets in a trade. So you wouldn't really do this, you would have some other logic to make sure that your inventory is adequate and so on, but let's run this and watch it work. So I run this, and now it should be, when it gets a buy signal, it should start buying. There it is. Look, I haven't checked the time, so I have a feeling I'm probably going towards over. But what I would say is that you can do much more than this. You can go use Redis, for instance, to go out to other servers, to servers nothing to do with ProfitView. You can take data from them. You can have your secret algo, for instance, running somewhere else and publishing to Redis, and use that as buy signals. Or you can get data from public sources. You let yourself imagine what you can do. You're not restricted when you're using ProfitView. I've got some examples, I'll publish them too. For instance, one using SQLite, and that actually is part of using SQLite with Google Sheets for trading. You can send to Telegram, send alerts to Telegram. You can use OpenAI. You use the OpenAI API. Of course you can. This is freely usable full Python 3. And then I have an example, for instance, where I send alerts when there are certain parameters breached in your algo to Telegram, so it'll tell you when you've got to pay attention. So, like I say, that should be some time. Anyway, I'll wrap it up there.
So my name is Kum, short for Kumran. So I'm going to speak to you today about triangular arbitrage for cryptocurrency. So who here already knows what triangular arbitrage is? Okay, a few, good, that's good. I don't want too many of you to know, but hopefully by the end of the talk you will. So I put triangular in quotes, and I'll explain later in the talk why triangular is in quotes. Arbitrage, I'm sure you know, is basically exploiting inefficiencies in markets to make, in theory, risk-free profits. And cryptocurrencies, I'm sure you know as well. So this is actually a strategy I ran back in 2022. Again, I was starting out as a hobby. My background, I grew up in Australia, did electrical engineering there, worked as an engineer for a number of years. About a decade ago, I moved to the UK to do a PhD in engineering up in Cambridge, and then after that, I moved to London, left engineering, went into strategy consulting, so I worked at McKinsey for a few years, and now I work at a telecommunications company as a director there. So quite the opposite of Richard. None of my professional experience is in trading or finance. It's all kind of engineering and strategy consulting. So yeah, I'll dive in. So Anthony mentioned that this is hopefully a forum for kind of anyone's getting interested. So I wanted to basically point out what you're going to see today is my first time I ever developed a strategy. Until then, my investing was really like buy and hold index funds, so no like active trading. I'd never worked on automated trading systems. I had no experience with like crypto exchanges or APIs at all prior to this. No experience with cloud computing platforms, and never really traded cryptocurrency. So this, what you're going to see today, is like me starting out completely fresh a few years ago. My programming experience was really just what I learned in undergrad and during my PhD. So I worked as an electrical engineer. I never worked in any of these roles before. By the way, opposite of Richard's talk, if you have any questions, please interrupt me throughout the presentation. I want to make sure that we're all kind of following what's going on. So, I mean, there are loads of types of arbitrage that exist. When people think about cryptocurrency, probably the first one that comes to mind is what we call cross-exchange arbitrage, which basically, can you read this, or is this, yeah. So cross-exchange arbitrage is basically the same asset being traded at different prices in different exchanges. So this was made quite famous by Sam Bankman-Fried back in the day. Alameda Research were basically he observed that the price of Bitcoin on US exchanges was like $10,000 and on Japanese exchanges was like $11,500 So he's like, basically what the principle is, you buy Bitcoin in the US for 10,000, you send that same Bitcoin across to Japanese exchanges, you sell it for 11,500, so you've guaranteed yourself, 1,500 of profit. You send that money back to the US, and you just keep repeating the process until the markets have equalized. Obviously, these kind of price inefficiencies don't exist today because of people like him and various firms like that have basically brought efficiency to the market. So that's cross-exchange. What triangular arbitrage is, I've just got a very, very simple example, and I'm going to go into more detail soon, of fiat currencies, right? So imagine, and these are exchange rates I took from Google last week. So you have US dollars, you have a certain exchange rate of US dollars to pounds, so you might put $1 in and get 80 cents out. Similarly, you have an exchange rate between pounds and euros, and an exchange rate between euros and dollars. So if you imagine you exchange dollars to pounds, pounds to euros, and then euros back to dollars, in a perfectly efficient system with no fees, no spreads, you would get your dollar back, right? You put in $1, everything's perfect, you get your dollar back. There's no gain or loss to be made. In real life, you have two things that affect that. So you have spreads, meaning that the exchange rate in the reverse direction is not exactly the inverse of what you put in, right? So I can't exchange $1 for a pound and move that back and get the dollar back. You have some spreads, and then you also have fees. So you're paying commissions or trading fees. So in reality, you put $1 in, you make 3 trades, you're going to get 90-something cents back. You're not going to get that back. But, so that's basically like what real world is. There are going to be minor inefficiencies that exist for very small amounts of time, where let's say something has happened, the US dollar jumps or collapses, perhaps one of these will move faster than the other, and then for a split second, you'll have an inefficiency where you have the dollar in and get a small amount. So that's what triangular arbitrage is. Now, if we apply it to cryptocurrency, so when I started out, I basically looked at 3 types of cryptocurrency, 3 assets, which were basically, the reason I picked them was they were the most popular assets. So USDT, which is a stable coin, it's called Tether, US dollar, Bitcoin, and Ethereum. So basically, it's bidirectional. So you can imagine you have a triangle going this way, which is a clockwise triangle, or similarly, a purple triangle, the anti-clockwise going back. It's bidirectional. Everything here is what we call a liquidity taker, meaning the orders are on the order books. I'm not market making here. I'm taking orders that already exist on the order book. So I'm paying, if I'm buying at the ask price, and I'll go with an example on the next slide. I'm buying at the ask price, and therefore I'm paying the taker fees on top of that, or I'm selling, if I'm wanting to sell, I'm putting in a taker order that's selling at the bid price, and the amount of the asset I get is the amount minus taker fees. Theoretically, this is risk-free. In reality, it's not. The 2 main risks, so one is execution risk, which basically means if I see an order book, or 3 order books, let's say an order book for each of these assets today, at this instant in time, and I can see there's an arbitrage opportunity, by the time I've realized there's an arbitrage opportunity, placed my trade, and my trade is put to the matching engine, the order books have changed, potentially. In that case, I don't get to execute all 3 trades at the price I wanted, so that's what we call execution risk. And then there's counterparty risk, which is very real in cryptocurrencies, where basically the exchange, you put your money on, right? So I've got all this money sitting on an exchange. There's obviously risks of theft and exchange bankruptcy, which we've seen quite a few crypto exchanges in recent years. One interesting thing is there's no separate exit for this type of trades. You can imagine, most types of trades, people will, predict that the price is going to go up or down, or 2 asset prices are going to converge. So you kind of enter the trade at one point in time, and then you exit at some point in time. It might be seconds or minutes or days or weeks later. So you're really like defining a separate entry and exit point. This has no entry and exit point. It's just a single instantaneous trade. And this is quite an important point, which I'll get to more, but basically this is all done during, Binance had a promotion in 2022 for a few months, where basically there was no trading fees at all. because that the costs to trade were basically just the spreads, which is what made this strategy fun. So a real example. So I've basically, again, this is a screenshot from last week. I've got order books for Ethereum, USDT, Bitcoin USDT, and ETH BTC. I'm just showing two price levels, the top two price levels for bids and asks. In reality, obviously, there's hundreds of more price levels in each direction. And I'll just work through an example. So one thing to observe here, this is super efficient, right? The spread between each bid and ask is literally just one tick for each of these assets. So it could not be smaller threads. So this is a very, very efficient market. And I'm going to assume 0 fees as from when I did it. So imagine we want to go through this clockwise loop. Have many of you had experience with cryptocurrency before? Yeah, a few. So what these assets here, so there's a symbol on Binance that we call BTC_USDT. Basically, that symbol means if you buy that symbol, you're exchanging Tether for Bitcoin. If you sell that symbol, you're exchanging Bitcoin for Tether. So that's just a symbol you buy or sell to shift between these two assets. So if I'm going in the clockwise direction, let's say I start off wanting to exchange Tether for Bitcoin. To do that, I want to buy this asset, and because I'm a taker, if I have to execute my buy straight away, I have to buy it at the lowest ask price. So that's what I'm going to do. And when I do that, if I put $1 in, the amount I'm going to get out is 1 divided by that ask price. So that's how many Bitcoin I'm going to receive for that $1 I put in, or 1 Tether I put in. Now I've got that Bitcoin. The next thing I want to do is convert that Bitcoin to Ethereum. So similarly, I want to buy this ETH_BTC asset, and again, I'm buying it at the ask price, and I'm going to receive 1 divided by the ask price of Ethereum. And then to complete the cycle, I want to convert that Ethereum to USDT, and then I want to sell this time this asset. And because I'm selling it, I have to sell it. If I'm guaranteed to sell it, I have to sell it at the bid price. So I'm going to receive per Ethereum, I'm going to receive roughly 3,000 USDT. If I multiply these three things together, I get a cycle value of 0.9999 something, right? So it's less than 1. So obviously this, if I did these three trades, I would lose a tiny amount of money. Yeah? And that's going to be the case the vast majority of the time. So with less liquid assets, you're going to have even bigger spreads here. So that's going to be even less. With fees, it's going to be even less still. But this is nearly always going to be less than 1. Any questions yet? No. And if I did the same thing.
How do you treat asynchronicities between the order books? Right? Because if you suppose you have, let's say, a database of each of these 3 bitcoins, but then there's delays on the next step that
Yeah, that's going to be on the next slide, actually.
Yes, about the volume of exchange, if you choose like the wrong exchange, like the volume of your order maybe.
Yeah, exactly. That's the last point here, actually. So the volume. So I mentioned the dollar going in, right? Imagine I come out with a cycle that's greater than 1. How much can I can't just put like $1 million in and hope it's going to trade. I'm going to be limited by the volume. Whichever of these legs is the smallest is what's going to be my limiting factor. And there's lots of stuff that's interesting there that I'll touch on, but not going to go into that one. So as I said, this example here, I just took a screenshot at a moment in time, almost guaranteed to be less than 1.
Sorry, but you can use the volume even in your advantage, because maybe the order book, like for if you just place completely very big thing that is like mess up, and you know how you mess up your order book is going to become big.
Yeah, I mean, so there's probably strategies to do where you try and pretend to buy to move prices in certain directions. What do you mean?
No, because like the order book, like right now is this difference between like you said like only 1 different at the moment, but maybe if you maybe remove like maybe $1 million worth of orders in the book, then it's gonna be different.
Yeah, so but that actually works against you. So if I was to like buy all of this, that will actually increase the spread and reduce the arbitrage. So you really want a tight spread for so anyway, the main thing here is less than 1, but there will be moments where this is greater than 1. The problem is, maybe back in the day, or with what Sam Bankman-Fried was doing, you could manually check it every now and then, see there's an arbitrage opportunity, and act on it. In reality, these exist for like fractions of a second, so you can't keep checking until there's an arbitrage opportunity. That whole system needs to be automated. So basically, as I said, this is my first time building any kind of automated trading infrastructure. So I started out with a super simple MVP, where I had WebSocket streams to Binance for these 3 symbols that would basically, in real time, message me the top of book price and quantity, and then order placement was just done via Binance's REST APIs. And then I had all my kind of post-trade analysis. Started out logging to CSVs and then just started logging to databases, but again, outside of the hot part. So outside of the path between getting the message and sending the trade on. I want that to be as quick as possible. So at the minimum kind of compute in that path, and any analysis and logging happens after the trades are placed. And then the one thing I noticed is doing this, there were tons and tons of orders that were filled as makers rather than takers, meaning I see an order on the order book. I tried to buy or sell in response to that, but I wasn't like if I try to, let's say this on this slide, I try to buy all these. By the time I get there, they're already gone, meaning I'm too slow, basically. So that was a question.
Yeah. You sent limit orders or market orders?
Good question. So I sent limit orders, but in theory, it shouldn't make a difference. If I'm fast enough, a limit order and market order should be getting the exact same orders. Yeah.
Did you get it with the gas fees and Ethereum?
No, so this is all on exchange. There's no actual trade moving between crypto wallets.
Did you go straight to like the live deployment, or did you backtest it as well?
Yeah, so this is a good question. I didn't backtest.
Okay.
Because I don't actually know how to backtest arbitrage. So what I can do is I can sit there and let it monitor and see there's opportunities coming up. But I don't, for example, have the database of tick by tick data. All the data I can get back is like 1 minute high low data. It's not like tick by tick. So what I did to kind of test it was just live trade with $5 or something. I put a tiny amount of money in, let it just play, and then I could see errors in my code. I could see like I was getting orders rejected because when I was doing that, I mentioned you have to divide the smallest quantity. I would have to divide to figure out what's the winning quantity, and I'd buy that many Bitcoin, but I'm buying like 2.1734983, and then I get a message from the exchange saying you can only have 4 decimal places in your order. So these kinds of things I kind of ironed out through live trading with small amounts of money, and then once I started to iron out, and this kind of, I hope answers your question, because it's a WebSocket. Like I'm constantly up to date with like the latest prices. So if there's one that comes in a second later, but Ethereum hasn't moved for 5 seconds, that's just going to keep me. It's always asynchronous. WebSocket by nature is asynchronous, so I'm always getting the live prices of the top of the book. If not, we can talk more later. So as I mentioned here, main problem was I was getting lots and lots of maker fills. So I wanted to improve that. So basically, I need to get faster, or in reality, reduce latency. So there's a number of things I did, which I'll go through from most impactful to least impactful. So the easiest and simplest is basically moving this from trading on my laptop to EC2 instance. So the Binance's matching engine is in Tokyo. And you can basically just spin up an EC2 instance in the same region, same availability zone, meaning that hundreds of milliseconds of latency became like single-digit milliseconds of latency. So that cut out the vast majority of the time. Second thing, this is quite an interesting one. So I described the process earlier of I start with Tether, I then buy the Bitcoin, and then I buy Ethereum, and then I buy Tether again, right? But what that means is my second order can only happen after the first one's complete, and my third can only happen after the second one's complete. So in reality, I can't place these orders sequentially because by the time the third order is placed, it's like it's been milliseconds at this point. So what I have to do is place all 3 orders at the same time. Right. But the problem with that is that third order requires me to go from, let's say, Ethereum to Tether. I don't have Ethereum until the other 2 orders are placed, so I basically need to maintain a balance of Bitcoin and Ethereum at all times as well. And what that means is I now have exposure to Bitcoin and Ethereum that I don't necessarily want. For me, I was fine with that. I didn't mind holding Bitcoin and Ethereum, but if you did care, you could like hedge it with futures, for example, like go short on futures, so your exposure is neutral. And then the third thing, again, there's full order books, and if you take a full L2 stream, then you can kind of make your own local copy of each order book. That takes some time though, so every time you get a message in, you have to go and update your order book. I kind of suspect because these opportunities are so tiny, even when you go one depth into the book, they're gone. I thought I was fine just to stream on top of the book. It meant I may have been, if there was a big inefficiency that goes through 5 levels of the order book, I would have missed that. I would have just traded on top of it. But again, for the sake of simplicity, I was fine with that. The other big thing is there was parts of my code that were quite computationally intensive, and I'll go into that in the next slides. And this is all built in Python, right? I was just trying to build this thing quickly. Python is great for developer speed, not great necessarily for kind of high frequency or low latency stuff. So I took the kind of hardcore computational parts and compiled them to C using Cython, and that gave me like a factor of maybe 100 speed up. So from the data, from the message hitting my algorithm to going out was in the order of microseconds rather than milliseconds. And then the last thing kind of goes to your question. So where, let's say there is an arbitrage opportunity and I want to execute on exactly those prices, I could sometimes just rather than going for those prices, I could kind of bring the prices in a little bit. Like I could make my prices worse to basically just aim to break even. If in reality the order hadn't moved, I could fill those prices. But I guess I just wanted to make sure I got filled as well. Optimize for arbitrage opportunity. So I use kind of worse prices as well. Any questions so far?
Very profitable.
Yes. Yeah. I mean, we'll go into the results at the end. There were definitely periods of non-profitability due to basically that execution risk I mentioned at the start, where when I'm too slow, I just keep executing opportunities I think are there, but then the market has moved and I end up holding an asset I don't want, and it's declining in price. Yeah.
Only when fee were 0 you were profitable, or even
Only when fees are 0. Yeah. And again, I'm going to touch on that last slide on what it would take to be profitable. So, as I mentioned, I started off with just one triangle, Ethereum, Bitcoin, Tether, which is fine, but there's probably, there's hundreds of crypto assets. So how do you start thinking about expanding? So I wanted to generalize the system. And there's 2 ways of generalizing it. One is covering more triangles. So for example, I could cover whatever, C4, C5, C6 as a triangle, or Ethereum, C4, Bitcoin as a triangle, like more and more triangles. And the other thing is, a triangle is just kind of arbitrary, right? You could do anything. You could do a 4-sided edge or a 5-sided edge or whatever. So I wanted to cover all kind of potential cycles that could exist. Here I'm only showing, I think, 10 edges between these coins, just for the simplicity of the diagram. In reality, if every pair was tradable with every other pair, you would see 30 different lines here drawing up all these circles, all these nodes. So that's kind of what I wanted to do, is try and generalize this. This example with just 6 coins, so with 3 coins, remember there was 2 paths, right? There was the clockwise path and the anti-clockwise path. With 6, if every single pair is tradable, you end up with 394 different cycles in each. So every cycle with 3 edges, you'd have 40 of those paths. Every one that has 4 edges, you'd have another 90 of those. With 5 edges, you'd have 144 paths. And if you considered 6 edges in any kind of shape, you'd end up with 120 paths. That's how you get 394. If you expand this just to 10 currencies, you'd actually end up with over 1 million different paths you have to check. So it becomes like a lot of computational time.
Are the longer paths more profitable, more or less often than the short paths?
So that's actually what this point here is about to say. So in general, all else being equal, the more paths you add in, the less likely it is like an arbitrage opportunity because you're kind of paying a spread on every one of those. But one thing I probably would go back and change, or not change, but if you're trying it. So I think the reason I picked these three currencies was because they were the most popular and I just had heard of them at the time. In reality, their popularity means they're also extremely efficient markets, and very efficient markets are less likely to have arbitrage opportunities. So if you went for less liquid cryptocurrencies, they're more likely to have pricing inefficiencies, and they're also likely to last longer than pricing inefficiencies and have gone in a fraction of a second. They might exist for seconds at a time. So less popular assets are more likely to have arbitrage, but the popular cards in general will be worse.
And how many of those currencies would you have to hold, depending on how many?
Yeah, so another good question. I mentioned like the need to do all three once. That was absolutely the case for these three assets because, as I said, the inefficiency lasts for so short. But if there's like some coin that trades every few minutes, you probably don't need to hold that asset. You can buy it and then milliseconds later sell it. So you only need to hold the assets that you think, where those inefficiencies have gone in under say 5 milliseconds.
But have you got a formula for it? Work out the formula is.
No, that's when you just need to like check the liquidity of each
But
asset.
assuming that they're all very liquid, let's say.
Then you need to hold all of them.
Wouldn't there be wider spreads with the more illiquid assets?
There will be wider spreads, yeah, but so there would for sure be wider spreads. But like, let's say I don't just name every coin I can name is pretty liquid. Let's pretend there's some brand new coin that's out there. It would have wide spreads, but there's a chance that if Bitcoin rose in price, the price between Bitcoin and that asset would change potentially quickly. But between Ethereum and that asset, no one may have noticed and may not change. So even if spreads wider, that inefficiency won't be like gone straight away. Okay. Other questions?
Are you using any extra features apart from pricing?
Only price and volume. Only price and volume. So how do I generalize this? How do I go from this kind of thing to a more general example? So you can use graph theory. So you can basically make this system into a system where each vertex is one of your crypto assets, and each edge, so let's say I have vertex 5, vertex 6, edge 5, 6 represents the exchange rate from this node to that node. And let's say I want to check, again, an arbitrage between these three. Basically what I'm trying to do is check that E12 times E23 times E31 is greater than 1. Does that make sense? So if I go through every kind of one of these parts, if I multiply the edges, any cycle that has all their edges multiplying to greater than 1 indicates an arbitrage opportunity. So how does that help? Well, in graph theory and in computer science, this is kind of similar to a known problem, which is called the shortest path problem, which basically means from one node to another, you can calculate kind of what are the different paths to get from one node to another, and what is the shortest of them. So this is obviously used in things like, if I was to try and get directions from here to West London, there are all these different paths, and if I was to add up the weight of going north and then west, or south and then west, or then straight west, like you could add up those times. So here, if I was, let's say, hypothetically wanting to get from vertex 1 to vertex 4, I could go 1 to 2, 2 to 3, 3 to 4, add up these three weights, and that gives me the total time by that path. Or I could go from 1 to 6, 6 to 4, add those two weights up, that gives me that path. I haven't shown it here, I've only got an edge from there to there. If I had an edge in that direction, I can see what that weight is. Exactly, so yeah, that's one I'm going to talk about in a moment. So that's like a solved problem. But again, here I'm adding weights. So how do I convert from my multiplication of a loop to adding weights, and how do I actually break this down? well, remember I said like E12 times E23 times E31 has to be greater than 1. If I take the log of both sides, I have log of, let's call it ABC, has to be greater than log of 1. I'm not sure if you guys remember your log laws, but log of ABC is equal to log A plus log B plus log C. And log of 1 is just 0. So now this is equivalent to log plus log plus log has to be greater than 0. And then I'm going to do this step, which may not be super obvious why, but I'm just going to multiply by -1. So I have negative log of E12 plus negative log of E23 plus negative log of E31 has to be less than 0. So what this means is an arbitrage opportunity is equivalent to finding any negative weight cycle in this graph. Does that make sense? Yeah. And why do I do that? So you mentioned Dijkstra's algorithm. There's also like Bellman-Ford and Short's path. So Dijkstra's algorithm doesn't actually work if you've got a negative edge weight, but Bellman-Ford does, and it basically will tell you if you just run Bellman-Ford's algorithm on this, it will tell you when there's a negative cycle.
What about the start
I don't know that one, but it might work as well. And there's loads of short of these ones, but Bellman-Ford's one that I ended up settling on. So what this is telling you is effectively, if I take in, let's say, a price from the exchange, which is the price from Bitcoin to Ethereum, which might be these two, I take the negative log of that rate, and I do that for every WebSocket measure that comes in. I just update that edge on a path with the negative log of its trading exchange rate, take into account trading fees. If I then run this, rather than running a million path checks, if I just run this, it'll tell me, hey, there's a negative weight cycle with these 3 nodes or whatever, and that's my arbitrage. That makes sense. So this basically lets you take an arbitrarily large number of coins and just run one algorithm that tells you where there's a Yes, but this will tell me, rather than me checking through a million, this will tell me that V1, 4, 5, 6 has a, and then I don't need to figure out exactly what the volumes are that limit that, but it just brings that straight to my check. What's that, sorry?
Is it exact algorithm or it's
Exact.
let's say it finds not the shortest price, but shortest with probability 0.9.
No, it's exact, yeah, it's deterministic.
And you don't necessarily need to find the shortest, you need to find one that is less than 0,
Yeah.
it's not the shortest.
It's only less than 0. But it's not going to be like, in general, it's not going to be like 35 or less than 0. So these things happen
Yeah,
like very, very
but what you say, even the computation is very complex, you don't necessarily need to find the very best one, as long as you find one that is less than 0.
Exactly, yeah.
What is the longest path you recall?
I think like five symbols, yeah.
A question I wanted to ask. So in reality, you have like a complete graph. So theoretically, you could trade it. Is there any process that you use to figure out which edges are worth checking in the first place? So would you, if there was a very low trading volume between the two currency pairs, you say that checking it? So
So that's something that I thought about. I didn't actually get to this. For example, if I got an update on the Dogecoin Tether pair, that doesn't affect the Bitcoin Ethereum Tether triangle price. It's completely separate edge. So like the edge over here means I shouldn't have to care about checking that one over there. I never it was an idea I had never really figured out how to modify the algorithm to not check everything again, but only check the edges that are impacted by that message that I just got.
It's on electrical engineering. I don't really understand what's going on. But when I opened the book, it reminds me a bit of electrical diagrams there.
Do you think your background in electrical engineering helped you?
Maybe were you biased towards thinking about this type of problem?
Yeah, for sure. I mean, I've always loved math. I think electrical engineering is probably like the mathiest of all the engineerings, and I think this is a particularly mathy problem as well. It's not like the math here isn't hard; it's multiplications and addition. But I think I've always found like that part. I find myself drawn to any kind of problem that can solve like that. And also the nice thing about trading is success is very like measurable. Like it's the dollars in your bank account basically. So I think it's a fun problem to optimize.
Yeah. So you mentioned before you were running this on an EC2 instance. Assuming this, you probably want to scale across multiple machines. How many machines are you?
It was always just on one. It was not even on a high house.
Oh,
it was on like free one. So when you set up EC2, when you first set up the Windows account, you get like 12 months of EC2 for free. Not very powerful. And I was able to run this.
Have you ran it on a Lambda function before?
But I think they have like spin up times, right? I think it's like it takes a few milliseconds for a Lambda function to spin up, and again, I want to be in and out in microseconds.
Okay. But wouldn't parallel processing across multiple machines make it faster? Like if you calculate the logs on every, like in real time in parallel or something?
Yeah, but so you only calculate the logs every time a message comes in, and the messages aren't coming in like 1,000 at the same time. They're coming in sequentially. It's a short time between, right? You might be getting 1,000 messages per second, but even there you're getting milliseconds or some amount of time between them, and that the part about calculating the log is pretty quick. But you're right, like the amount if I want to run this Dijkstra's algorithm on every WebSocket message, that potentially means running it thousands of times per second, which is why I had to go from Python to C to kind of just optimize that. That was the part that was computationally intensive and speed up.
So you use this algorithm, but they will find the shortest path from one point to another, but not the number.
Yeah, so
this the last stage
yeah, so the way I describe the shortest path is, I define a start node and node, but you can modify it on and forward to, instead of specifying this node I'm starting from, this is where I want to get to, just basically loop over all the nodes and find like every cycle that's in there.
you should find it good. So keep it complex much better than trying to find the shortest path without requirement to come back to the same place. Have you seen instead of the challenge there?
No, I'm not sure I follow that. Let's talk more.
Beyond shortest path, let's say you find the shortest path where you find an opportunity that requires an extra hop but has much deeper liquidity with the smallest leg. Did you adapt this to account for that, for capacity for the whole cycle?
So, no, probably I should. I only assume that we only find like one negative weight cycle at a time, and I would exploit that in full, and then of course if I read it again with another one, I would exploit that in full. But there is, to my example, if like Doge Tether rate change, it might be that all of a sudden there's now 4 parts that are all negative weight. I didn't like try and find what's the best of those. It's like, oh, I've got one, that's great. Like, it happens so infrequently, let's just take it.
Yeah, I was just asking, when you said earlier on that the arbitrage opportunities with these high trading cryptocurrencies is often less, because they happen so fast, and therefore you've sometimes got to hold some in your balance to be able to do the trade as you're doing it. Does that mean that the lesser traded ones have a better opportunity for you?
Yeah.
Why aren't you, or have you done any of that?
So I did expand into that. So I started out, as I said, with no knowledge. I just was like, let's just go for the most common ones. But then I think the vast majority, more opportunity in the less liquid assets, right? Like this whole arbitrage, by definition, is like exploiting inefficiencies. So find like the least efficient ones are going to be the less liquid, the least traded
You have a problem like you have like 3 different order books. You can't make a conditional order based on 3 different books. So
No, you have to place three independent orders.
So 3 different orders, maybe 2 of them might feel and the third one not.
Yeah, that's the execution risk I talked about at the start, and I'll go into like the effect of that in a slide. But that's basically the entire like if I could guarantee that I would fill all three. So, like, I would be so happy.
This could be a market gap from an exchange perspective. You can make like maybe the possibility to place orders like on conditional.
I mean, if there was a custom order type that was like fill all three or none, that would be perfect. I don't know that exists though.
So you only used one broker, right? You didn't send orders.
No, this at the time I did it was exclusively with Binance. But I'll go into it and expect other exchanges. So, I mean, I think you guys decided to ask all these questions. We have 2 slides left, so you know that kind of theory I hope is pretty straightforward. There's a lot of complexities here. One is managing asset balances over time, and what I mean by that, let's just go back to my simple Tether, Bitcoin, Ethereum example. I mentioned I have to have an amount of all three. Let's just make numbers easy, right? Let's pretend I have 1 Bitcoin, which is roughly $50,000. So I have to have 50,000 Tether, and let's pretend Ethereum is 5,000 Tether, right? So imagine I start off with 50,000 Tether, 1 Bitcoin, and 10 Ethereum. So these are all roughly balanced, which means, you know, I can maximize the size of any triangle. If the price of Bitcoin now collapses, right? So it's only worth 10,000. Now I've got an unbalance. I've got 50,000 Tether, but 1 Bitcoin which is worth 10,000. So I need to like continuously kind of balance out the assets as price changes. And same thing with arbitrage, right? Like if I put in $1 and I'm saying I get back $1.01, if I do that 1,000 times, all of a sudden, like some of these assets may start to grow because that's where the arbitrage is like leaving the excess in. So again, I need to like figure out how you manage these asset balances. The big thing you just asked, you know, what do I do about unfilled ones? If I only fill 2 of the legs, what do I do with the third leg? Do I just let it sit on the order book and hope it gets filled? If it's not filled after 10 seconds, do I still leave it? If it's not filled after 2 hours, what do I do? So do I cancel orders? Do I just say, okay, you know, just fill it? I think you asked about filling market price. Do I just fill it market price and keep the loss or something else? That's another big problem. You kind of mentioned already using market orders versus limit orders, and then using multiple exchanges. So you could run this same strategy on other exchanges, but you can also potentially run it cross-exchange, right? So if all I'm trying to do is go from Tether to Bitcoin to Ethereum, I could go from Tether to Bitcoin on one exchange. I could have a different exchange which takes that same amount of Tether of Bitcoin and converts it to Ethereum, and then a third exchange where I convert that Ethereum to Tether. So it doesn't need to be all in the same exchange. The problem there is I've now lost Tether there and getting Bitcoin here, so I either need to like send that Bitcoin from one exchange to another, which then incurs fees, or hope that there's a negative cycle to kind of bring back the balance. But there's a lot of stuff you could potentially do there. And now the interesting part, you guys hopefully, is the results. So I mean, I ran this for months. I'm just taking one snapshot here. This is the best performing snapshot. This is not representative of performance. So this is basically over a period of 42 hours. So what these 3 graphs are, the top graph is the balances, so balances over 40 hours, and I've taken the dollars off, but I'll explain what they were. This part here is just to zoom in at this. So I'll explain each of these. So the blue line is basically the starting balance. So I start my bot running at a certain time. You know, it has whatever balance, and that's just kept here. The orange line is my do nothing line, and why that moves is, as I said, if I start with some amount of Bitcoin and Ethereum, as the price of Bitcoin and Ethereum move, my like do nothing, don't even trade, it's going to also vary as the price of those underlying assets change. The blue line is my theoretical line, so that's like if every arbitrage opportunity I detect, I trade on and it gets filled at the prices that I've seen, that's what my portfolio should look like. And the green line is what it actually did look like, so that takes into account I didn't fill at market rates. I didn't fill at the rate I thought I would, or whatever happened. So that's my actual performance. So what my uplift is basically what I did versus what we did. So this here shows percentage. So in the perfect arb scenario, it would have made roughly 30% in 2 days. The green line shows it ended up making roughly 15% in 2 days. The blue line should be whatever it's monotonically non-decreasing, so it's just always up. There's no reason this strategy should ever lose money. In reality, it doesn't always go up and to the right because of execution risks. This here does look up and to the right, but as I said, this is literally the best run that I ever had. For 2 days, there were plenty of runs where it ended up losing money, so I've written it's a bit like picking up pennies in front of a steamroller, which means I might make thousands a trade that each make like tiny fractions of $1 or something, and then I make one trade that one leg doesn't get filled, and that like undoes 5,000 good trades in one loss. It's like this, and a big cliff, and you just hope that these cliffs are smaller than all the ramps up. The other thing is this is something it's actually great for me, kind of great for me. It's not scalable because it has limited capacity. What that means is, this looks like an incredible return, right? If I was to put in 100 times the money, I don't actually get 100 times. I don't get this again, right? Imagine, you guys are familiar with the concept of capacity? So imagine I have a strategy where I put in $1,000 and I get $2,000 back. That's great, double the money. But then I put in $100,000 and I get $101,000 back. So that's capacity constraint. It means like there's only $1,000 to pay, no matter how much money I throw at it. Once I've exhausted the inefficiencies, that's all I can get. So this is not a scalable strategy because I'm capacity constrained by the amount of inefficiency there is. So you think that's a bad thing. The reason it's good is it means that like James Street isn't going for this, right? Because they only care about strategy that can put like millions of dollars into. If there's stuff that prints tens of thousands or hundreds of thousands per year, it's great. Like people like us can do that as individuals without worrying about these massive funds coming in and taking it. So that's kind of like some space at the bottom of the market.
So like, for example, you have a lot of money, you can just modify completely one of the 3 order books. And then there are other people reacting to this. And you other people reacting. I'm not sure if it's legal doing like this.
I don't know if it's legal or not, but that's just a different strategy now, right? Like, so that definitely happens.
You can place a big bet on an order book, and then you know that after some time it will go back to normal. So then
So I think
you don't lose the money on your big bet, but then you take advantage of the reaction.
Yeah. So
You don't like spiffing market.
yeah. So that's it may be possible, but it's not triangle arbitrage, right? This is what a lot of companies were doing, I think, in the 80s and 90s, like trying to drive momentum by buying lots and lots, and then the rest of the market starts buying, and then they can sell before the rest of the market starts selling. So, I mean, it's a different strategy.
So you do it like this, but not only with one lesson. Then you bet on what people react.
Yeah, I mean, potentially it's valid, but it's not this. It's not this strategy.
It looks like the actual profit rate in some sections is just almost do nothing. Does it mean that you have actually just a few trades over a fixed period of time?
So this was roughly 70,000 trades.
Yeah.
So it's trading thousands per hour. Yeah, 1,000 trades per hour. But there will be. So for example, this part here, that was an hour or two where I don't know why I wanted to keep going. I was like watching this thing was just going up and up and up. So the market was just super inefficient for this couple of hours. That was like the craziest spike I ever saw. But the vast majority of the time it's like this. It's just like slowly. I'm still making a lot of trades, but the trades are just making tiny amounts of money.
Yeah, it's like at some point it's just better to do nothing.
Yeah.
You can zoom in at least.
Yeah. That's why I've written monotonically non-decreasing rather than increasing, because there will be periods if there's no inefficiency, they'll just sit flat for a while.
Yeah.
You see that? Where you have the steep slope on your actual graph, is that because of volatility in the market?
Yeah. Exactly. Volatility, and whenever you have volatility, you have inefficiency. Whenever you have inefficiency, you have a problem for this.
Question about what I've been.
Yeah. Cool. So, I mean, I'll keep going. So, as I said, it's not scalable. The peak month I had, I mean, I've taken the number up here, but it's like measured in the thousands, the amount of money I had. But in my peak month, I was trading like well into 9 figures. meaning like every dollar I had was getting cycled like 100,000 times in a month. So the trading volume is just enormous. And this is spot, right? Like these kind of numbers you see in futures, not infrequently, but like spot volume of over 100 million was fun to see. The next thing, though, the profit margin is like per trade is tiny fraction. Like this is making, 1%. I'd be super rich, right? It was making like tiny hedges. And as I also said, like this was working great for some time, and then literally 11:59 to midnight 01 stopped because financial promotion ended and fees went from 0 to 0.1%. And as soon as when you're talking about like 1.00001 as your ARB cycle, and you bring in 3 times 0.1%, it's like never going to be profitable. So I think, and then to the last point, I'll take a question in a second. So it's still not, I think for us, it's not really a profitable strategy to run, but you can still run this and just run the monitoring part of it, so you can see how often these things come. So, I mean, as a plug to Richard and Jahan, when they told me about ProfitView, I put a lot of effort to build this infrastructure. When they told me about it, I went on there and within a few minutes, 60 lines of code in the interface that Richard showed. I had something that monitored this triangle on 3 different exchanges and was showing here's where there are opportunities where there's 0 fees, and with the impact of fees, here's where it actually is, it's less than 1. So it's super easy to code something out where you can see where these opportunities are. You can also see how long they last. So, if you see an opportunity exists and you wait for the next message where the opportunity disappears, it might be milliseconds or seconds. So you can see kind of how long these arbitrage opportunities, how long they last for. And as I said, I've left this strategy running for a few days on their platform, and it's come up with opportunities, but they're pretty rare. Like before, as I say, getting thousands per hour. Now it's like a couple every day, and it's just not worth me keeping mining there to make like a few cents, basically. Yeah.
You could try to leverage trading.
No. I mean, again, because the amount of money with the capacity was relatively small, like with a few grand, like if there was like millions of dollars required, then I would try and leverage, but the amount of money I was not able to risk it, so I didn't bother leveraging.
Okay, so then again, what the do nothing line?
Yeah. So why the do nothing line is like this is based. So imagine the markets didn't move, right? I only had to hold tether. I could exchange my tether for Bitcoin, then exchange my Bitcoin for Ethereum, and then back. But as I said, I need to hold Bitcoin and Ethereum because I want to place all 3 trades concurrently. And because I want to hold the balance of Bitcoin, I want to hold the balance of Ethereum. If I do nothing, if the Bitcoin price increases, then if I do nothing, will increase equals.
So this is a portfolio, right?
It's just a portfolio. It's like portfolio balance. Yeah.
Because you're measuring tether value.
Yeah, this is all portfolio value. Go back to tether. So if I converted my Bitcoin to tether, if I converted my Ethereum to tether, basically the price of my portfolio tether equivalent, which includes Bitcoin and Ethereum.
Did you have any like automated controls for the strategy, so or you just monitoring it manually?
It was just completely running by itself. Like again, when I first started out, I was just looking at the console, like Python console window. So super basic. I mean, with current strategies I'm currently doing, I've built like a front end in React, so it's got like a WebSocket connection to my strategy, so I can just pull out my phone and go to a website I've got and just see it all there. But back at this time, it was just watching the console window.
Did you sleep for that period?
So I was just like staring. I was hoping it would never stop.
Comparing the value that you put on the scale, you took out
So I mean, in 2 months, probably $80,000. Just decent difference.
I wanted to ask a question. So, throwing back to what you were saying about how we can choose. You said, okay, well, maybe you notice that one is really affected by another one that's really correlated together. I'm thinking that if you were to notice and gather your data on what's correlated with something else, it might be easier to then close certain positions if you end up in a situation where the end is no longer profitable. What I'm thinking is, say you're going from currency like 0 to n, if you go through a path of them to get what you want, if you know that 0 is correlated with n, and you know that there's a big movement in 0, then you know that n is probably going to move. So then maybe whilst you're going through this chain to try to exercise your arbitrage, it's probably not going to exist anymore. So then maybe you can try to then close that.
Yeah.
Because it's quite
So if you're
correlated.
on the way to your path and it moves,
Yes.
would we exit it?
Yes, because you're saying that if you have this understanding of the correlations between them, then you see that movement in the original one, and you know it's quite likely that this one will also change, and maybe close your arbitrage.
Yeah.
So then you don't go through this whole process potentially to end up wasting your time.
Yeah, makes sense. There's also another thing I didn't talk about, which I never tried this, but another extension could be. So everything here is taken, right? Like I'm only ever taking order of liquidity off the order books. There's probably a way to adjust this. So rather than waiting for an arbitrage opportunity to happen, I literally say like, okay, I know these two edges have this way. What does this third one need to be to become profitable? And then I can place a maker order saying if the price drops to this and these two haven't dropped, then that one will get become a maker and these two become a maker. The problem with that is it's just changing so quickly that I would be like placing and cancelling orders like thousands of times per second, and I'm pretty sure it's going to stand like that.
The engineering challenge scales up.
Yeah. And someone also asked, like, is it profitable? One thing you can do with this, live monitor, as I said, is you can set it to, if there's 0 fees, how often does this come up? The answer is pretty often. But often with crypto exchanges, you have like VIP tiers. So I mentioned the 0.1% of Binance. That's like what it would be for us if we trade like under 5 million a month or something, we pay that. But then as you trade more and more and more, I think the top tier is if you trade $1 billion per month, the fees become consistently smaller and smaller. So you can kind of see, like, if I went to Jane Street and I know they're VIP 10, potentially this is like, for their VIP tier, they actually do have lots of opportunities where I can't trade them, they can, because their fees are small.
How did you get the idea of fraud? But you said you're on the background in engineering.
Yeah.
Currencies are dodgy, so I wouldn't even touch that stuff. But
I mean,
right? Common source.
I don't know. I was just like playing around with the exchanges. Like, it started out as me like wanting to learn how to. I didn't have an idea for a strategy. I was like, let's just set up these streams and see what kind of data I get, and then play around with these. And then over time, I just had all this idea of what if this works, and then I read other stuff and then I started loving it. And as I said, since this is from 2 years ago, since then I've like kind of come with a bunch of other strategies as well, but they're all on similar kind of arbitrage lines. Right now I'm doing a lot of stuff with futures, and each of these has been like, oh, that looks interesting, and then start reading and researching and testing.
More educational.
How are you connecting to the exchange? Like, is it one where you connected to a broker which is connected to
No, so this is an EC2 instance that's just getting website feed directly from the Binance exchange.
from the which exchange?
Binance.
But there is like 160. So which one are you? 160.
Binance.
How many crypto exchanges are there?
No, so, I mean, there's dozens of crypto exchanges, but the one that I was on, which is one that had this promotion, is called Binance, probably the biggest one.
What about your level 2 data? How are you getting? Where are you getting the streams from? Who's supplying it?
Same exchanges also supply level 2, but for this I wasn't using level 2. The ones the strategies I'm doing now I am, but each exchange will have top of book streams as well as the full level 2 streams. And I'm sure there's stuff you can do with connecting to 20 different exchanges and getting all that data and then seeing if one exchange moves faster than the other or something. Stuff you can probably look at. I'm guessing it's all tapped out by institutional investors, but I think that's where you start to learn, and then you can find things for yourself.
What advice would you have for someone who wants to get involved in this but maybe doesn't know where to start? maybe they know how to code, they don't have any ideas, or they kind of have ideas but they don't know how to code.
So I have ideas for what to code, like ProfitView.
But like, would you, if, like, did you consider teaming up with someone, or do you think,
So
is that something that you think would work well?
it's something that I think would work well for sure. I mean, the part of the reason I joined this group was for 2 years, I literally just did this by myself, reading like Stack Exchange and Reddit and random like, because I knew no one was doing this. So the algorithm you referred to last month, that was like, I went there like, there were people doing this like as if I'm interested in it. So that's why I came to meet people who were interested in this. So I think like a forum like this is great to meet people. I mean, the advice is, I think you don't have to have like a solid idea that's profitable. I think you just need to like start building something. Even if it's just printing things to console, and then things look interesting, and then from there you just find. My path has just been like trying things that looks odd. But the same with my PhD. Like I didn't know what PhD was going to be when I started it. Start reading, start testing, and then as you expand your knowledge, you see like interesting things where there could be opportunities.
You could read the Robert Calvert's Trading. That's an introductory, friendly book, and Robert Calvert is a serious person. And you don't need to program. You can also do actual work, excellent worksheets, which you would seem like to be a pain, but that's a good book to start.
What's that book called?
It's Leverage Trading by Robert Calvert.
Colbert, CU.
Robert.
Do you do any on-chain stuff? Do you do any on-chain stuff now?
Yeah.
Or is it only down?
That's something again I'd like to do. And that's the things I want to try. But this is still excessively out of yet.
I heard you mention books, and one of the things I'd say is that's kind of what the forum is for. If you want to talk about the books that you're suggest them in the Telegram. It's genuinely interested in how to learn this. That's why we set you to have a discussion.
Some time ago, I put together a spreadsheet of all these resources. I think just go back to it.
Yeah, so touch it again, please.
Yeah.
It's a pretty good answer, right? Also depends on the level. There's a good one, Optimal Universal Trading, but it's just mathematical. It's horrendously complicated. Optimal is the first one.
You said you do future stuff now. Do you do like the funding rate arbitrage?
That one's still happening,
Okay.
and it's capacity constrained. So
Yeah.
maybe in like at some point in the future when it's finished, I'll do a talk on that one as well. But yeah, so.
Oh, thank God finance entered their promotion so we can actually talk about this. Cool. Well, thank you very much for talking about this. Suggest twice a year, they go to the chat and talk again, and let's socialise a bit.